So in the previous video, we saw an introduction to the Reserve Bank of India. We also touched upon something called the Monetary Policy Committee, and that setting the monetary policy rates was one of the functions of RBI. So in this video, we're going to be looking at Monetary Policy Committee, policy rate, repo rate, reverse repo rate. What are these? So the RBI Act provides the statutory basis for the monetary policy framework and the Monetary Policy Committee. We have already discussed in the previous video that there is an RBI Act of 1934 and then one in 1949. So this is the act that provides the statutory basis for the monetary policy framework and the Monetary Policy Committee. The Monetary Policy Committee is a committee within the RBI. Okay. So the central government constitutes a monetary policy committee by notification in the official gazette. The central government, in consultation with the RBI, shall determine the inflation target in terms of the consumer price index once in every 5 years. This needs to be notified in the official gazette. So, it is the central government that consults the RBI, and then there is an inflation target that is set. So, what is this inflation target based on? It is based on the CPI, that is Consumer Price Index. So this is done once in every 5 years. So basic questions that arise is, what is inflation, right? So we say that we set a target for inflation. Then we have to understand what is inflation. For example, today if a liter of milk costs 50 rupees and then in the next year it costs 55 rupees, then we say that there is an inflation of 10% in the price of milk. Okay, this is inflation. Inflation means a rise in price for the same quantity of commodity from one year to another year. It does not have to be any year, it can be any period of time basically. So inflation means price rise without a change in quantity. Okay. So for the same amount of money, you can buy lesser amount of a product. That is what inflation does to you. Also, another term that we looked at is consumer price index. Consumer price index is an index of a number of commodities that is used in the daily life of any citizen. So there is an index that is formed, and this is known as a consumer price index. So the inflation target that the government and the RBI have to together achieve is looked at, and it is based on by the consumer price index. So once in every 5 years, the Monetary Policy Committee is formed. Okay. So what does the Monetary Policy Committee consist of, or who does it consist of? The first one is obviously the governor of the RBI, right? The governor of the RBI is the highest official of the RBI. The second is the deputy governor of the RBI, who is in charge of monetary policy. There are many deputy governors within the RBI, but in the Monetary Policy Committee, we have a deputy governor who is in charge of the monetary policy framework. The third point, one officer of the RBI to be nominated by the central board. The fourth one is 3 persons to be appointed by the central government. So these are the 4 types of people who are there in the Monetary Policy Committee. The Monetary Policy Committee has been entrusted with the statutory duty to determine the policy rate required to achieve the inflation target. So just now we discussed that there is an inflation target that the RBI and government have to together achieve by discussing with each other. Now, the Monetary Policy Committee has also been entrusted with the statutory duty to determine the policy rate required to achieve the inflation target. So how do we achieve an inflation target? Now, let's say I don't want inflation to go above 4% or 5% per year. I don't want inflation to go more than 4 to 5%. How do I achieve this? So there are some ways to target inflation. It is also known as inflation targeting. So there are some methods and some things that we can do to achieve a certain inflation target. The first method to do it is policy rate. So what is policy rate? In simple terms, policy rate is the rate at which the central bank lends to other banks in the country. So in the first video, we saw that the RBI acts as the banker to all the scheduled commercial banks, including nationalized banks. Correct? So now policy rate is the rate at which the central bank or the RBI lends to other banks in the country. That is all the other banks like the scheduled commercial banks. This can include nationalized banks and it can include private banks as well. For example, SBI is a nationalized bank, ICICI is a private bank. Both of them can borrow from the RBI, that is the central bank, at the same rate, and this rate is known as policy rate. Okay, the policy rate is used to target inflation and other short term lending rates in the country. So what is the need for a policy rate? So we understand that the policy rate is the rate at which the scheduled commercial banks borrow from the RBI. The policy rate is used to target inflation and other short term lending rates in the country. In India, the policy rate is also known as repo rate. Okay, in India, the policy rate is also known as the repo rate. So, if you have to define repo rate, how will we define it? We'll say that the repo rate is the rate of interest at which the RBI lends to scheduled commercial banks or other financial institutions in India. This is done against government securities. Okay, now let's say SBI wants to borrow 100 crore rupees from RBI. What will happen is yeah, SBI will now say here are some government securities that are worth 100 crore rupees. Please take it and give me some loan for a day or 2 days or very short term loans. In fact, scheduled commercial banks borrow overnight also from RBI. Why they do this, we will go into it in the videos that are to come. Okay, but for now you have to understand that policy rate and repo rate are the same, and the repo rate is the rate of interest at which the RBI lends to scheduled commercial banks in the country. Now, similarly, how there could be a deficit sometimes in scheduled commercial banks, in which case they will borrow from RBI, there will be certain conditions where the scheduled commercial banks have excess money. So, in this case, what they will do is they will park their money with RBI. Okay, so in this case, they will park their money with the RBI. So, the rate at which the scheduled commercial banks lend to the RBI or park their money with the RBI is known as reverse repo rate. So, reverse repo rate is the rate at which the scheduled commercial banks park their money with RBI. So, I hope this is clear and that there is no confusion. Repo rate is the rate at which the scheduled commercial banks borrow from the RBI. Reverse repo rate is the rate at which the banks park their money with the RBI. So, reverse repo rate is generally 50 basis points lower than the repo rate. So, what does basis points mean? For example, in news you would have heard 50 basis points, 100 basis point, RBI has hiked interest rate by 100 basis point. What does it mean? 100 basis point is 1%. Okay, 100 basis point is 1%. So, we say that reverse repo rate is generally 50 basis points lower than repo rate. So, this means that it is 0.5% lower than repo rate. So, if scheduled commercial banks are borrowing at a repo rate of let's say 5%, then reverse repo rate will be 4.5%. This is generally how it is. If the repo rate is increased, then inflation also increases. Remember that repo rate and policy rate are the same, and policy rate is used to target inflation. So now we are coming back to this part. Okay. So if the repo rate is increased, then inflation also increases. If the inflation needs to be reduced, then the repo rate also has to be reduced. There is very simple reasoning also behind it, right? For example, if the banks are getting funds at a lower rate of interest, it will give it to customers at a lower rate of interest. If there is a lower rate of interest, then borrowing becomes easy and there is better economic growth and prices are stabilized. Okay, this is the reasoning behind it. We'll understand this very clearly in the videos to come, but right now this is all you need to know. Okay, so if the repo rate is increased, then inflation increases. If the inflation needs to be reduced, then the repo rate has to be reduced. So managing the repo rate is just one of the aspects of inflation targeting, and inflation does not depend only on repo rates. There are hundreds of factors. For example, let's say the price of tomato is today 100 rupees, but in some months of the year it is 10 rupees or 8 rupees also. Why is this? This is also based on supply demand. So there are various things that are at play that affect the price of a commodity, and that affects inflation in general. So what you have to understand is inflation does not depend only on repo rates, but repo rate is one of the tools with which we can target inflation. Now coming back to Monetary Policy Committee. So the decision of the Monetary Policy Committee is binding on the RBI, and the RBI shall publish a document explaining the steps to be taken by it that will implement the decisions of the Monetary Policy Committee. Okay, so Monetary Policy Committee comes together, and then it starts to bring certain decisions, or it starts to take certain decisions as to how the monetary policy framework of the country should be. Okay, the decision of the Monetary Policy Committee is now binding on the RBI. Then the RBI has to publish a document explaining what steps it has taken to fulfill the decisions of the Monetary Policy Committee. The Monetary Policy Committee meeting has to be held at least 4 times a year. So this is about the Monetary Policy Committee. So we have seen about repo rate and reverse repo rate in this video. I'll just sum it up, including some differences between repo rate and reverse repo rate. So repo rate is the rate at which the RBI lends money to the banks. Reverse repo rate is the rate at which RBI borrows money from the banks, or at the rate at which the banks park their money with the RBI. Repo rate is higher than reverse repo rate, and reverse repo rate is generally 0.5 percentage lower than repo rate. Repo rate is used to control inflation and to address money supply. Okay, I repeat, repo rate is used to control inflation and to address money supply. Reverse repo is used by the banks to manage their cash flows as mandated by the RBI. So the purpose of the two things are very different. Repo means repurchase agreement, and reverse repo means reverse repurchase agreement. Okay, we'll come to it later. But you have to understand that the use of repo and reverse repo is completely different. Repo is used so that we can address money supply in the economy. Reverse repo is used by the banks to manage their cash flows as mandated by the RBI. RBI has certain guidelines saying that banks have to maintain a certain amount of cash at all times. So we have two different ratios for that: cash reserve ratio and statutory liquidity ratio. We'll come to that in the videos furthermore in the course. Okay. So the fourth point that we look at is repo involves the sale of securities which would be repurchased, in the future. So like I said, repo means repurchase agreement. Repo involves the sale of securities which should be repurchased in the future. Reverse repo involves the transfer of money from one account to another, that is from the account of scheduled commercial banks into that of the RBI. So this is just an introduction to how a monetary policy committee works and how it is connected with the RBI. We have introduced the term policy rate, we have introduced the term repo rate, we have introduced the term reverse repo rate, and we have understood a little bit about it. These terms will continue to appear in all of the videos that are to come from here. Okay, so please watch the video multiple times if you have any doubts. Thank you.